Alright, how y'all doing? Shirley back here with another video. So, glad you can join me, glad to see you. Glad you can join me on my YouTube channel. So, just want to talk about a few, a few things dealing with accounting, probably business, and maybe computers. So, let's start out with a little, short tutorial on accounting. So just want to start out just in case I have some beginners. So first of all, let me introduce myself. This is my channel, Shirley Hubbard Show. So I am Cheryl Hubbard Walker, and graduate of Strayer University, Bachelor's in Business Administration. And I do have 3 adult children. And my major was business administration, but I did do a minor. I didn't do a minor, but I did a second degree in information systems. So in my bachelor's in business administration, I did take a couple of accounting courses. I took, I think it was accounting, introduction to accounting, and managerial accounting, and where we learned about financial accounting and management accounting. And so I guess that's about it. Yeah, my degree, I have 2 degrees, information systems and a bachelor's in business administration. And so let's get this ball rolling. So let's talk about accounting. First of all, what is accounting? Accounting is a system that measures business transactions, form those transactions into reports for decision makers. So who are your decision makers? Your decision makers are your managers within the organization. They need information to make, you running a business, you're working as a manager, you're owning a business, you need certain information coming in. See, and my other degree is information systems, so we learned about different methods that you can, I guess would say implement, different measures that you can implement to bring in that information. Because bringing in information to your organization, your corporation, or small business, if you're a small business owner, that is very vital to you and your business, because you have to know what's going on, what's going on out in the environment, I guess I would say. What are your competitors doing? What are your customers doing? You want to keep a track of your competitors, your customers, your employees, trends in the market, different technology trends that come about. So you want to keep your business up to date. So if you running a business and you don't have the most up-to-date technology like the next business down the street or around the corner, then you're going to be left behind. So that is, dealing with business. So in accounting, let's start off. Okay, I said, what is accounting? It's the system that measures business transactions, form those transactions into reports for decision makers. So you have financial accounting, which are your outside decision makers like your SEC, your Security and Exchange Commission, auditors, creditors. I guess I would say banking, the banking system. You want to open up a bank account, or you want to apply for credit. They might want to know. More than likely, they're going to want to know how financially stable you are. So whether you are an individual or you are a business, they want to know how financially stable you are. Because if you want to get a loan, they want to know how can you pay this money back? Are you going to be able to pay that money back? So let's just start out. In other words, accounting is a system that measures business transactions, forms those transactions into reports for decision makers. So we talked about the decision makers, which are your in financial accounting, those are your outside decision makers. Managerial accounting, that's your my son over there. So financial accounting is for your outside decision makers. Management accounting is for your inside decision makers. Supervisors, managers, whoever is in that position to make decisions for that organization. So in other words, those transactions that are formed into reports at the end of the accounting cycle probably would be transactions like business transactions. In other words, you open up a business. Say for instance, you just started your business and you invested. Say for instance, you invest $50,000 to open your business. You would debit the cash account. In other words, you have a business bank account because you don't want to commingle your funds with your personal account. So you want to have a business bank account. Say for instance, my business, Shirley Cosmetics LLC. I will open up a business bank account with, credit union or with the bank, and I will call it cash. It will be cash and owner's equity. It will be cash and owner's equity. Let me make sure this is neat. So one transaction always affects two accounts. So if I open up a business and I invest my $50,000, it will affect two accounts. One transaction always affects two accounts, so that will be cash and owner's equity to start my business. Cash and owner's equity. So I would debit cash $50,000. Credit owner's equity $50,000. That gives me $50,000 worth of equity in my business. So this will be a transaction that can be used at the end of the accounting cycle. So remember I told you the definition was, the definition is when, the definition of accounting is the system that measures business transactions. So this will be one business transaction that will be placed in my, I guess I would say, well, you can put it in your journal. The journal of accounts, the chart of accounts. The chart of accounts is the chart of all your accounts for your business. So depending on what type of business you run, will determine the type of accounts you have. You might have definitely you might have a cash account, accounts receivable account, office supply account. You can make it into your T account. So you definitely, depending on the type of business that you run, that will determine the type of accounts that you would have for your business. So this may be one transaction that may go into my business, all my business transactions. So this will be one. And then also, what if you want to buy some office supplies? Let's see something. Hold up. So what if you want to purchase some office supplies? I want to pull the computer up a little bit. What if you want to purchase some office supplies? Okay, that's a little better now. Look here. So what if you want to purchase some office supplies? So you already invested $50,000 in the business. So you open up a cash account for your business, the name of your business, as I said, Shirley Cosmetics, or whatever business you want to call. You have your business. You can say your business. Your business on your bank account, on your bank account name. So you say, if you run a t-shirt business, you can say Sally's T-Shirts Incorporated. It still will be the same. Sally's T-Shirts Incorporated. Invested $50,000. So with debit cash, since cash is an asset account, all asset accounts are debited on the left for increase. I'll write bigger, I can say it better. All asset accounts are debited on the left for increase. So say for instance you invested $50,000 cash in the business you just opened. Then you want credit owner's equity, debit the cash account. Cash is an asset account. All asset accounts are debited on the left for increase. Then there's owner's equity, credit owner's equity on the right. So this will be another transaction that will go into your reports. So accounting is a system that measures business transactions. So this would be a business transaction. This is a business transaction too as well. Also, Another business transaction will be you purchase office supplies. So all these are transactions that will go into your reports at the end of the accounting cycle. You want to purchase some office supplies. You want to purchase office supplies, and then how do you want to pay for those office supplies? Do you want to pay through accounts payable, or do you want to pay, let me make sure that music is on. Say for instance you want to purchase some office supplies. Office supplies are assets. So let's go with office supplies. Office supplies. Office supplies are assets. You're going to debit office supplies on the left for increase. All assets are debited on the left for increase when we're using the T accounts. Using my T accounts. So office supplies, and we can pay, let's pay through accounts payable. Say this, if we pay through accounts payable, then we want to credit accounts payable on the right. Because accounts payable is a liabilities account, and credit on the right for increase. So since we're increasing our accounts payable account, credit on the right. Office supplies, say for instance we want $2,000 worth of office supplies. So when you purchase office supplies, you're gaining an asset. So you debit on the left for increase. So office supplies are assets to your business, and you're paying through accounts payable. So you want to credit accounts payable $2,000. So this will be another transaction that will go into your reports at the end of the accounting cycle. And sometimes before the accounting cycle is over, you can always do a trial balance. You can also do a trial balance anytime in the accounting anytime within the accounting cycle, you can do a trial balance to make sure all your debits and credits have to match. In other words, the first transaction was invested $50,000 in the business. And so if I invest $50,000 in my business, it will be cash. There was cash and owner's equity. So you can write it out like a journal, straight across like that. So cash, you debit cash for the amount that we put in, and you credit owner's equity. So you have to make sure it's lined up. Credit owner's equity and debit to cash. So you write it out like a journal, straight across. So then you can also, when you want to make a trial balance, for the trial balance, you can do it like this. Put a line over here, then you got your debits and credits like this on this side. Debits and credits, and all your accounts over here. All your accounts on this side. Say for instance, you got your cash, office supplies, inventory. You got all your accounts on this side, and then on this side, your debits and credits. So they definitely have to match up. They have to add up at the end. They have to equal on both sides. So this is what they call the trial balance. All your accounts are on one side. You got debits and credits on this side. So when you say cash, we put $50,000. I deposited $50,000 in my business bank account. So I definitely will come over here. All I want to do is my trial balance is debit my cash, because that's what I did when I did my T account. So debit my cash account $50,000 because I deposited $50,000 in my cash account. And then we purchased some office supplies. I think we did that, what was that, $10,000 or something like that. So that would be a debit too. So as long as it's lined up on the debit side. Office supplies, $10,000 debit, cash, $50,000 debit. So when you get finished with all your debits and credits, they have to equal on both sides. So that's what they call the trial balance. You put the line down the middle, all your accounts on this side, your cash, inventory, office supplies, whatever accounts you have for your business will be on the left side. And then you have your debits and credits that you want to make sure they are in the right place, and make sure all your debits and credits equal to your accounts over here. Instead of making it equal over there, you want to make sure it's equal over here. You want to make sure the debits and the credits equal down. You want to make sure the debits and credits equal down here. Debits and credits have to equal right here. So then you got the debits and the credits. So they have to equal on both sides. Debits have to equal to your credits. So accounting is the system that measures business transactions, form of transactions, and two reports for decision makers. So these are some of the transactions that will be formed in two reports. You invested $50,000 in your business. You purchase office supplies. Those are transactions. You purchase equipment. You purchase equipment and technology for your business. That's another business transaction. You purchase items on accounts receivable. Your business, you purchase stuff on accounts receivable, or you purchase stuff on accounts payable. Someone coming into your company and purchase something. Say for instance, they sold some merchandise on accounts receivable. If you sold merchandise on accounts receivable, there will be another transaction that would be formed into reports at the end of the accounting cycle. So say for instance, you somebody purchased I would say $20,000. Somebody purchased $20,000 worth of t-shirts on account in your business. Somebody purchased $20,000 worth of t-shirts on account, and they paid you cash. So we're gonna go with cash and accounts receivable. Somebody purchased $20,000 worth of t-shirts on account in your business, and they paid cash. So in other words, you receive the money right away. So we want debit accounts receivable. And since they paid cash, we're also debit cash because it's coming into the cash account. Also, it looks like it would affect owner's equity. The owner's equity account is real. So they pay. So basically, the difference, the most, I would see the most, I wouldn't say the most important, but I would say one of the differences between accounts receivable and accounts payable are that accounts payable, they don't pay the money, they don't pay for it right at one time, all at one time, they pay for it later. And so accounts receivable, usually you get your money right away. So somebody purchased $20,000 worth of t-shirts on account, or whatever they purchased. They pay cash, so that will affect the cash account and accounts receivable. So those type of transactions are the transactions that will be formed into reports at the end of the accounting cycle. So those transactions. So we touch base on debits and credits. Let's talk about accounts payable real quick. In other words, somebody come into your business, or even you can go to somebody else's business and create accounts payable. You know, somebody came into your business and you sell jeans. You sell jeans, t-shirts, you sell everything. But they wanted to create an account payable because they want to pay for it in 30 days. So they wanted to create accounts payable. They want to create accounts payable. So you'll label that accounts payable. So one transaction always affects two accounts. So if they want to create, say for instance, they purchase some t-shirts, they purchase maybe $10,000 worth of t-shirts on accounts payable. So let's go with, I guess I would say that would be, it could be, I would go with, I don't know if I would go with inventory or, I guess I could go with inventory. It still is part of your inventory. So if they purchase some inventory, from your business, that will make your inventory, it will go down, it will be less, it will decrease. So I won't debit on the left. I would debit on the inventory is an asset account. So to increase the asset account, you debit on the left. So they want to purchase some of your inventory. If they purchase some inventory, that means it's going to decrease your inventory account. Say for instance, I say what? 10,000. So you want credit inventory 10,000, and credit accounts payable 10,000. So they created accounts payable. That means they're going to pay for it later. They didn't create accounts receivable. So on your books, you might put it down as, you still can put another section on your book, let's say it's accounts receivable, because they created accounts payable, but they're not paying anything right now. So they're not paying anything right now, but when they start to pay, then you're debit accounts payable. Your debit accounts payable on your books, and also you can credit accounts receivable on your books because you receive the money. So that's how they go. Okay, so there's accounts payable, talking about accounts receivable. Let's talk about withdrawals. The withdrawals account. Say for instance you run a business and you want to take some money out the business bank account, which that is not a business transaction, but it's your business. That is your business, you own it, and you can take money out your business bank account. So say for instance you want $70,000. You want to withdraw $70,000 out of your business bank account. Number one transaction, two accounts. So you'll create a withdrawals account. Withdrawals account. You want to debit withdrawal $70,000. It's coming out to the withdrawals account. And I would probably go with owner's equity. I would go with owner's equity since money is coming out. Instead of crediting owner's equity, I want to debit owner's equity because it's coming out. Debit owner's equity, and I want to debit the withdrawals account. Now, if money coming into the business, you would credit owner's equity because there will be an increase. But since it's decreasing owner's equity, you want to debit owner's equity on the left, debit the withdrawals account on the left, debit owner's equity on the left. So it's good to practice these debits and credits. So what else can we do? I did office supplies, withdrawals. What else can we talk about? Talk about accounting and system that measures business transactions, form those transactions into reports. So we just did 4 or 5 transactions. Those transactions will be formed into reports for decision makers. And 9 times out of 10, if you are running a big company, you probably would have a separate entity for your accounting department. So, but if you're a small business, you still might have somebody working in the accounting department, or you might be your own accountant. So, okay, let's talk about So those business transactions, those are the ones that will be formed into reports for decision makers. And also, you have the decision makers. Then you also have the decision makers. You have the financial accounting, which are your outside decision makers. The management accounting, which is considered to be your inside decision makers, like your managers, supervisors, or whoever in the inside is, I guess I would say, not capable, but I would say in charge. The ones, the managers, you have the first line managers, you have supervisors, so whoever is in charge of making those important decisions based on the information coming in. So all businesses, most businesses, I guess I would say, should have an information system set up. Whether it's pen and paper, whether it's blackboard, how do you bring your information into your organization? Are you using technology? So that's what they call information technology. That means you're using technology to bring that information in, because you have mainframe computers, supercomputers. We also have our laptops, our desktops. We have our fax machines. So many. We have FaceTime. We have Google. Everybody is getting into a lot of these technology devices, bringing in that information. So it's all good. It's good to be able to keep up with your competitors. You want to know what your competitors are doing. In business, you always want to be unique. What can I do that is unique? And what can I do in my business that is unique that I can keep pulling in my customers? So what about your target markets, your marketing channels, how you want to advertise, market, and promote? That is very important, because that's how you pull in your customers. You want to pull your customers in, and you want to keep them coming back. You want to have great customer service. How is your branding? How are you branding? You have good customer service. How you treat your employees? That's important too. So your branding is everything. Your colors, your logos, your labels. How you treat your employees? How you treat your customers? How you treat everybody? I guess I would say. So you want to build a strong brand. You want to build a strong. You want to build a strong brand. You want to have products and services that I guess I would say they could be unique. Products and services that provide to the customer what you say these products and services are going to provide. You can't be a person in business and then you offering a product or service, and the product doesn't stand up to its name, basically to your business name. So that's part of branding too. So look at Walmart, Kmart, Target, Amazon, all these big names, companies. So what do you think? Why do you think people keep going back to them? Why do you think people keep on going to me? And then now we are online. So what is the main purpose that you feel? Why do you feel that we are, I guess I can say this myself. Why do I feel that or why, I can just say why do I keep going back? Why am I constantly ordering online from Target, Kmart, Walmart, Amazon? Why am I constantly ordering from those companies? And my answer would be, I don't want to say I feel. My teacher never liked us to say I feel. Or never, I always say, don't say I feel. Just say what you want to say. I can say honestly that I love to shop at Walmart, Kmart, Target, Amazon. I love to shop because I always had great experiences, and great customer service. The products that I ordered, so they usually outsource with other companies, but I really never had any problems with anything that I ordered from Amazon, Target, Walmart, Kmart, any of those. I never had any problems because over the years they all have built strong brands. They have built a strong brand, strong, reliable brand, dependable brand, great customer service, you know. So how many years in McDonald's, Wendy's, Church's Chicken, all the fast food restaurants, they all have built strong brands. So that's why we go back, because they have built a strong brand. Their products are quality. The products of the McDonald's still taste good after how many years? So I'm still ordering from McDonald's. So then we have Grubhub, McDonald's, Wendy's, Church's Chicken, Popeyes. They all are on Grubhub. And when you order their food, it's still good. It still tastes the same after what, 30, 40 years. So they have built a strong brand, reliable brand, dependable brand. You go to Kmart, Walmart, Target, and look, the clothes, everything in there. I mean, they sell jewelry, clothes, laundry detergent, soap, deodorant, toothpaste, t-shirts, jeans, whatever you need, they have. So it's like they have everything you need, and they have built a strong, dependable, reliable, trustworthy brand. So in other words, branding also includes how do you want people to perceive you and your company. You know, your personal brand, your company brand, your business brand. All of that is included in branding. You know, so you have to work on your brand, build a strong company brand. You don't want to be out in the street. You out there in the street, you cussing people out, and people remember you from your business. You cussing people out, being all nasty to people. People remember that. Oh, I know her. I used to shop at her store, and they look at you and they see how you acted out in public. They be like, you know what? I don't want to buy anything from that person, because you know you have people that run businesses threatening people and cussing people out, and some businesses, the customer service, you know, you order something and, you know, we have to step our customer service game up as well. If someone orders something and they have a problem, you always supposed to adhere to your customers and make sure they are satisfied. A satisfied customer is going to keep coming back. But if you have a customer that purchased something from you and they were not satisfied with their purchase, everything was wrong, you know, and they were like, look, I'm not coming back to this business. I'm going to take my business elsewhere. And then another thing, if you're running a business, you definitely want to keep up with the trends in the market. Keeping up with the trends in the market is very important. So like I was saying, technology, having the latest technology, and also having employees that can, you know, I guess a lot of these, some of these companies, you know, they may have like teams, and they may have training sessions. So they have training sessions so they can train the employees on new technology that may come about, you know. So if you're a company, you're a business, you know, you do your research, you know, but if you're a small company, you might not want to have a whole lot of, you know, technology, different technology. But I mean, it depends. I guess it depends on the type of business that you're running. So like whether you are like a hair salon or barbershop or something like that. So I've been in hair salons and barbershops, and I haven't seen none of them with any computers or nothing like that, unless they have them in the back, or unless they have their office at another site. Sometimes you can have your office at another location. But most barbershops and hair salons that I have been in recently, they have maybe like a TV or something, you know. TV where the customers can watch TV, but I haven't seen any like computers and fax machines and stuff like that in the barbershops and the hair salons. So, but like I said, that's why I say it depending on the type of business that you're running. So let me get back to accounting. So I digressed a little bit, but that was business and information technology. Talking about computers. Okay, so let's do a couple more transactions. Let me see. Let me try. Okay, let's talk about what about prepaid rent. First of all, let's list some of the assets we do have. Let's do that first. Assets and liabilities. Okay. Assets, we have prepaid rent. We have prepaid rent. Accounts receivable. Office supplies, we have land, we have buildings, prepaid rent, accounts receivable, office supplies, we have land, we have buildings, we do have inventory. Alright, so big. So what was it? Land, building, inventory. So like that. So these are just some of the assets. These are some of the assets that you will encounter when you're working on your transactions in your book. You know, if you study in accounting or you just want to, review, you go over some, make yourself feel familiar with some of these accounts. The prepaid rent is an asset because if you pay your rent up for 3 months, it's considered an asset. Accounts receivables are assets. So that's money that's coming. There's money that's coming into your company, or money coming to you or to your business, and you receive it through accounts receivable. That's an asset. Prepaid rent is an asset because if you pay your rent up for 3, 4, 5, 6 months or whatever, that's an asset. Office supplies are assets. Land is an asset. Say for instance, you're a company and you want to purchase a lot of land. Land is considered an asset. All assets are debited on the left for increase. So these T accounts, so they debited on the left for increase assets because when you're doing your T account, they are really just used for like I guess I would say a practicing mechanism. You practicing your debits and your credits. And also you can practice your debits and credits, like I said, through your trial balance. You can journalize, just write it straight across. Like you got a cash account, you have your cash account, then you line your debits and credits up over here. So you can journalize it like that in one book. Or you do a trial balance, like I said, you have per line down the middle, with your accounts on this side, and your debits and credits on this side. And make sure they equal at the bottom, trial balance. So it's good to do that. You can do that. You don't have to wait till the end of the accounting cycle. So these accounts right here, I mentioned these because these are asset account building. So building is an asset account. Inventory, buildings, land, prepaid rent, accounts receivable, office supplies, and land. So in other words, say for instance you're a company and you want to purchase some land. You're a company and you want to purchase some land. So land, buildings, office supplies, inventory, accounts receivables, prepaid rent, cash, all our asset accounts. So they will all be debited on the left with increase. Increase meaning there's money coming in, you increasing that account. So the T's are for the T accounts that represent each account, like your cash account. Say for instance you go to business and you purchase a building. You're a business and you purchase a building. So that is an asset. You want to debit that on the left. Say the building costs $100,000. I want to debit the building account $100,000. And then since you purchased it, you had to pay for it. So 9 times out of 10, well, if you paid it on accounts payable or you paid it cash, let's go with cash. So in other words, you purchased a building for your company. It would affect 2 accounts. There would be a building account and your cash account. So since you paid for it with cash, it's going to come out the cash account. So we're going to credit the cash account $100,000. Credit the cash account $100,000. So a good thing to do probably would be to go over the debit and credit rules. Study the debit and credit rules, that way you'll know. Study the debit and credit rules, that way you'll know. study the debit and credit rules. That way you'll know, you'll make yourself more familiar with where to, which side you debit, which accounts you debit on the left for increase, which accounts you debit on the right for increase. So basically, all asset accounts are debited on the left for increase, credit on the right for decrease. So like I said, wherever you purchase a building, wherever you purchase land and buildings, they will be both of those are assets. So land account. So wherever you purchase land, so land for your building, for your business, land for your business, you would debit the land account on the left. Because land is an asset account, or asset accounts are debited on the left. So this is a T account. We have our debits on the left, credits on the right. So you just have a D over here and a C. D and a C. So in other words, you have a land account like this. I don't want to be too far at the top, but it'll be like this. Like that. So in other words, you have your land account. So, trying to get this to stay, okay. You have your land account. You purchase some land for your building, your business. So land is an asset. You are increasing your land account. Land is an asset account. For the debit land account on the left, paid $100,000. I paid $100,000 for the land. Already affects two accounts, so the second account in effect will be cash. Cash is an asset account as well. I would debit on the left and increase, but I don't want to increase the land account. I want to decrease the land account because I want to decrease the cash account. Excuse me. I want to decrease the cash account because the money coming out of the cash account to pay for the land. So you credit the cash account. Credit the cash account $100,000. Debit land account $100,000 because you purchase land, you increase an asset. You increase an asset and decrease an asset at the same time. So basically, if you are beginners, a good thing to do would be to work on those debit and credit rules, work on your T accounts. So remember, one transaction affects two accounts. Work on your T accounts, work on your transactions, then also work on your terms. We have accounts. Work on your terms because this account's receivable. So you will have a T account for each account. In other words, you got accounts receivable, you have cash, you have a T account. You have a T account for each one. So depending on the transaction, that will have a lot to do with, depending on the transaction and the type of account that it is, that will determine which side you would debit on or which side you would credit on. Like I said, all asset accounts will be debit on the left. You debit on the left for increase. So you started your business. You invested $100,000, or you didn't have to start. Even if you didn't start a business, what if you made a cash sale? You were running a business and you made a cash sale, say $5,000. There was cash coming into your business. You would still debit the cash account. You debit the cash account $5,000 because cash is an asset account, or asset accounts are debited on the left for increase when you're dealing with your T account. That's why I say it that way, is when you're dealing with your T account. T accounts really, to me, is just, T accounts are, I guess I would say T accounts are mechanisms just to help you study your debits and your credits so you can keep the debits and your credits lined up. And also you can use, like I said, you can do trial balances. So trial balances, the T accounts are good too. I like the T account. You have T accounts, like I said, you can use T accounts to help you, and also you can use your trial balances. Trial balances. So like I said, the trial balance. Trial balance, you just say debits and credits on one side and the accounts on the other side. All your chart of accounts on this side, then you want to match up your debits and credits on like a trial balance. You want all the accounts that you have on that side. And so basically, if you have already done all your debits and credits with your T account, you just transfer your T account information over to your trial balance. You set it up like this. Make sure your debits and credits equal for your accounts. So that's the thing to do. A lot of times I just take my book and I review. It's a accounting book that I have. Big book too, thick book. See? So that's what I do a lot of times. I just review. So let's see, we did some debits and credits. We talked about the trial balance. Let's talk about our income statement. So we have the income statement, which is revenues. Income statement, revenues minus expenses. So you take your all your revenues. So revenues minus expenses equals net income. Revenues minus expenses equals net income. So that's on your income statement. So all your revenues. So if you cutting hair, you curving hair, you running a barbershop, you running a salon, all that is service revenue, that will come on your revenue. So let's just make up one and do one. So in other words, you got your revenues. Revenue segments is our revenues. Revenues, we got service revenues. We got our revenues, all our revenues, our service revenues, segments is equal to 100,000. Service revenues 100,000. And then we got our expenses. Segments, we got our expenses our expenses 50,000 for our business. And we minus it from our revenues. Our service revenues and our revenues came to 100,000. Our expenses came to 50,000. So we have 50,000 left. 50,000 left. Net income. So minus our 50,000. We have 50,000 left net income. So our revenues minus our expenses. Our expenses were 50,000. And we still have 50,000 left. So that's what's on the income statement. Revenues minus expenses. So you add all your revenues. Revenues are considered, in other words, when you make a sale, you sold some goods, you provided a service, you made money. Service revenue, all that comes under revenue. Add all the service revenue up, all your revenues up, add that up, add all your expenses. So your expenses, you have rent expense, you have salary expense, rent expense, you might have cost of goods sold as an expense. The cost of goods sold, that's also an expense too. A lot of times companies have tax professionals calculate their cost of goods sold, because cost of goods sold, in other words, if you're running an inventory business, cost of goods sold is calculated from your beginning inventory and your ending inventory. How much money did you spend on inventory to make the product that you made before you sold them? So that is what the cost of goods sold is. So that is an expense. Cost of goods sold is an expense. So they call it COGS. In other words, you running a business. Say, for instance, you running a t-shirt business and jeans and socks. You have to calculate for each product, each item you will calculate cost of goods sold. So in other words, how much did you spend to make those particular products? Say for instance, what if you made maybe $1 million, I guess I would say. What if you made $1 million at the beginning of I guess I would say at the beginning of the accounting cycle, you made $1 million, so you already calculated what you spent. So what did you spend on your products to make, you didn't have to make them, but you could, if you made your products, you also could also just, purchase from other companies. So that could go in, that would be included in your cost of goods sold too. In other words, if you run a t-shirt business or socks business or whatever business you run, but you're outsourcing and you purchase a lot of those products from another company, all that can go under your, that would be included in your cost of goods sold too. In other words, you purchase it from one company and then you purchase it from one company for one particular price, then you sell it to your customers for another price. So that's all included in your cost of goods sold. So how much did I pay for all these goods that I purchased or I made before I sold them to my customers? So cost of goods sold. So you may need a accounting professional, but it's good for businesses to learn the formula themselves. So they have to calculate the beginning inventory, what they spend for products to make that inventory, or I guess I would say to market or make those products that they sold. So they made them themselves, or they outsourced to other companies. They still have to calculate that in their cost of goods sold, because those are the products that they sold to their customers. So they had to, whatever money they spent on those products will go in the cost of goods sold, which is a cost of goods sold. That is an expense that goes under the revenue minus expenses that goes on the income statement. So cost of goods sold is an expense. So you always debit the cost of goods sold account, and you make another entry called inventory. You credit the inventory account. So in other words, your company, say for instance, you made a sale on account. You made a sale on account for just maybe $10,000. You made a sale on account, and then you sold some inventory. You're an inventory company. You sold some inventory. So you have to debit cost of goods sold, because you have to account for the money that you spent on those products that you purchased, and then you later sold. So that's what that is. But you can also always read more on it. I'm just getting the terms. I usually just mention the terms when I'm doing my presentation, because I do my little business presentations on TikTok as well. So I'll give you the terms. You can always go further, do more research. So I'm giving you basically the basics of what the word means, or T accounts, or whatever I'm talking about. I'm giving you the terms. I'm giving you basically the basics. You can always go further if you want to find out more. So we talked about cost of goods sold. We talked about all the different T accounts, asset accounts. Okay, let's talk about the liabilities. What are the liabilities? We talked about the asset accounts. What about the liabilities account? I got a few more minutes. The liabilities we did talk about accounts payable. We have accounts payable, we have interest payable, salary payable. So in other words, you're running a company and you have to pay your employees, so that's included in salaries payable. So that's also a liability. All those are being credited on the right for increase. Accounts payable, salaries payable, interest payable, and we have another one called accrued liabilities. So in other words, liabilities that are still adding up that you haven't paid before. Sometimes you have a certain date. Some companies you have a certain date. In other words, you set certain terms. In other words, you purchase an item and you set a certain date that you're gonna pay it off. I guess the company that you purchased from set a certain date for you to pay that off. So if you hadn't paid it off, and the interest is steady accruing, adding up. That's what they call accrued liabilities. So the interest is steady accruing on that payment that you missed, or that you hadn't, paid. You hadn't made that payment yet. So the interest is steady accruing on it. So accrued liabilities, the liability is still adding up, and you haven't paid it yet. So I think I'm going to close out. We got a few more minutes. So, okay, let's get back into, we talked about business. So what about, so let's talk some more about, in other words, you're running a business. It's good, my opinion, I would say that, I think everybody should learn accounting. When I first started taking accounting, I was leery. I knew my major was business administration, and I received my bachelor's in business administration at State University right here in Washington, D.C. But I didn't know nothing about accounting, and I didn't know what was going to be on the curriculum. But once I looked at my curriculum, and you look at the curriculum, and you see all the classes that you have to take for graduation, and I saw accounting on there. I'm like, the way it was written, it did seem interesting. But when I got in that class, I'm like, whoa. So when I got in the class, and we started working out this book right here. It's a nice book right here. I really credit my learning so quickly because of this book. I learned quickly because of this book. I like the way this book is structured. So when we started talking about the T accounts in the beginning, the book starts out telling you about different types of. First, I think we talked about the management accounting, managerial accounting, financial accounting. We talked about that. We talked about the inside decision makers, outside decision makers, your SEC, Security and Exchange Commission, the banks and credit unions. We talked about the outside decision makers. We talked about the inside decision makers, your managers. Managers within the organization, they have to make decisions. So managers get things done through people. So managers have to delegate, organize, control. They empower. They assign you. In other words, you work for a company. The managers make sure you are doing. They give you a certain assignment. They give the next employee their assignment. So everybody has, the managers, that's their job. They get things done through people. So the people that do all the work, the employees that do all the work. But so that's how you do that. So managers. So that's how the book started out. Tell you about financial accounting, management accounting. Then it goes into who uses accounting information. Then it goes into your different terms, your accounts receivable, your accounts payable, all your asset accounts, land accounts, and building accounts, inventory, office supplies, prepaid rent, all those accounts. And you have your owner's equity account, your withdrawals account. So you invested $50,000 in your business. You want to debit the cash account for cash as an asset account, or asset account for debit on the left for increase. Credit owner's equity account. So that was in the book in the beginning. Yeah, you learn all your terms: revenues, expenses, accounts receivables, accounts payable, cash account, prepaid rent, pay your rent up for 3-4 months. That becomes an asset. So you debit prepaid rent on the left. Debit prepaid rent on the left. And so on the left of the T account. So you work with the T accounts, and then the next thing, the book goes into the transactions. Then it goes into the transactions. It tells you initial investment in the business, Berry Line. My book said Berry Line, but I can use my company. Shirley Cosmetics, they can survive, invested $1 million in my business. I debit my cash account on the left, credit owner's equity, and then if I want to go back and credit owner's equity on the right, because they're increasing my owner's equity account, they give me the equity, they give me the amount of equity in my business. And what if I want to go back to office supplies? Office supplies are assets. So office supplies, always, like I said, one transaction affects 2 accounts. So whenever I want to purchase some office supplies, it would be office supplies and cash. office supplies and cash. Office supplies are assets. So I debit my office supplies account for whatever amount that I spend on my office supplies, and since it came out of cash, credit my cash account. Excuse. So those are just that is just one transaction, a few other transactions, and so I think I'm gonna wrap it up because it's about an hour. So I think I talked about just about everything I needed to talk about. I got into target markets and also, when you run a business, you always want to maintain a competitive advantage. You always want to be unique. You want to maintain a competitive advantage. You want to be, I guess you want to do something different. You want to do something more than what your competitors are doing. You want to do something more. You want to do more. You want to do better, something better. You want to do something unique. I mean, you have to benchmark. Go online. Go to these businesses. Go online. Benchmark. Benchmarking means going out and seeing what other companies are doing. What is this company doing that I know I can do better? And I want to do better. I want to do better because I want to pull in more customers. You have to do something. You have to be unique so the customers can keep coming back. I know I've been in some companies and they play music. Some companies they greet you right at the door as soon as you come in. I forgot what store it was, but soon you come in the door, they how you doing? All companies don't do that. They play the music, the place is clean, and they walk over to you and ask you do you need any help. Soon you come in the door, they how you doing? Welcome to Foreman Mills, or welcome to Kmart and Target and Walmart. I haven't seen them do that. I have been in there, I haven't seen them do that, but I mean, everybody don't have to do it, but that's a good practice because your customers can feel welcome. We definitely feel welcome. But I definitely have been in stores. Someone I walk in the door, how you doing? Welcome to blah blah blah. Yep. So they have businesses out there that do that. So that's being unique. That's what I say when I say be unique. That would definitely keep me coming back. And also, if you have good customer service, you are unique. You have products that are reliable, and a good price, a great location. That's all important. So I will close out, and because I was talking to my brother one day, and he said, "Sis, I went to your channel. I was watching some of your videos, and he said, I was in there listening to you. He said, you can really talk." He said, I was listening to you. I walked out the room, I came back, you were still talking. Oh boy. So I said, yeah. I said, yep, I've been trying to talk and get my point across, but I'm trying to give you some information. It's all included in those information systems that I was telling you about. So information is powerful. They say knowledge is powerful. Information is powerful. All in all, how you use it. Yep, so information is powerful, knowledge is powerful. So, I just hope that I can inspire someone to take, this accounting further, this business further, or this information systems further. So I'm working on now, trying to create me another product line, get my business incorporated, and so I'm working on that. My degree is business administration. So businesses, I love business, I love accounting. I like business and accounting, information systems. Those are my areas right there. So just hoping that I can inspire somebody with these little bit debits and credits. These little debits and credits, and I can inspire somebody else to be a CPA, certified public accountant, accountants that serve the public. That's why they call them certified public accountants. So, if I can inspire somebody to, take it a little further and say, hey, you know what, I might want to go study accounting. I might want to go study business. But business is good. Business is, I guess, if you can market, if you can build a strong brand, you can be down with your marketing, advertising, and promoting, getting that product out to the customers in an affordable fashion. efficient, I would say, getting out. In other words, we have affordable products. You have products that do what they say they're going to do what you say they're going to do. You have, you can deal with social media and proper marketing channels. Facebook, Instagram, YouTube, Twitter, now TikTok, they have their little business. You can open up a business account with TikTok, and then we have so many, different ways that you can market your business. So, but I'm going to close on this note because I can just talk. So, think about business, think about accounting, think about information systems, computer information systems, information technology. So, all those, things are related to business that help your business grow. Help your business grow. So, I want to thank you for joining me today. And, there's a loser in the background. So, thank you for joining me. And I want to say I hope to see you again. Hope you come back again on my channel. So I'll probably be getting my next lesson plan prepared. So thanks for joining me. Hope you all have a nice day. Also, I'll put my cash app and my Venmo information down below. So also, if you have any questions for me, if you have anything that you want me to talk about, anything related to business, county, law. You know a little bit about the law too, so I might be doing some law videos too. I think I have a couple law videos on my channel, so check me out, the Cheryl Hunter Show. And I didn't study law, but I took a couple law classes. I learned about men's rear, active rear, men's rear. I learned all about the court systems, and I know all about that. And I learned another term. I learned so many terms. I learned broken windows, the broken windows theory. So broken windows theory. That's when you, in other words, you have small crime, they lead to a bigger crime. So they try to clear those small crimes out, so it won't lead to a bigger crime. So in other words, they stop you. In other words, if you run a stop sign, to them that's a small crime. So that's why we may think, oh no, that's why they on everything. They on everything. So they're feeling that could lead to a bigger crime. So that's why you run a stop sign. I think it's a $50 fine, if I'm not mistaken. But so I'll be glad to see you in my next video. So I hope you will join me in my next video. Thanks for joining me on the Cheryl Hunter Show. And I want to say, I'll see you next time.